Griffins Financial Solutions, achieving your goals together.
Welcome to part 2 of our webinar on automatic enrolment and the changes to workplace pensions. Thank you very much for attending. In this second part, we will look at making contributions to a scheme, using postponement, processing opt-outs and opt-ins, record keeping, failure to comply with the regulations, how Griffins Financial Solutions can help, and then we'll run through some employer questions which set out some of the issues that employers have had so far and some of their questions. So looking at the contributions to a qualifying pension scheme for automatic enrolment, we'll concentrate on defined contribution, which are money purchase schemes such as personal pensions and stakeholder plans, and money purchase occupational pension schemes. Defined benefit schemes, which are final salary arrangements, have slightly different rules involved with them, but we'll concentrate for the purpose of part 2 on the defined contribution arrangements. The statutory minimum contribution that will be required from the 1st of October 2018 will be 8% total contribution. Now that's a minimum of 3% from the employer and the balance from the employee and tax relief. Contributions are a percentage of qualifying earnings, or in the case of certified schemes, which we looked at in part 1, pensionable earnings. Employers will have to track earnings at each pay reference period. For example, if an employer pays their employees on a monthly basis, then the pay reference period is a month. If it's weekly pay period, it's a pay reference period of a week. And one of the issues that people will have to look at, or employers will have to look at, are the complications of fluctuating emoluments and income during each different pay reference period. Contributions will be phased in from the 1st of October 2012, so it won't be a full 8% from day one. They start off at 1% employer and 1% employee, and then increasing all the way through to 3% employer and the 5% being the balance as from October 2018. If the employer is using the certification route by certifying an existing pension arrangement, the minimum statutory contribution will depend very much on one of the 3 or 4 options that are chosen, which could be 7%, 8% or 9%. One of the questions that people will have is, will the statutory minimum remain at 8%? There is a general feeling in the market that the 8% is too low a contribution to provide a meaningful pension on a money purchase basis for employees, and it is probably expected to be increased over time. The government haven't said anything about that, but the general view in the market is that it will increase at some stage. We mentioned in part 1 about the use of postponement. Now this is actually something which is quite a useful tool for employers who are using the automatic enrolment route, and employers can select to defer their automatic enrolment up to 3 months. So it's a deferred period up to 3 months. So it doesn't have to be 3 months, it could be 2 months, it could be a month, whatever is suitable for the employer. So they could use the deferment to assess their workers or the automatic enrolment date for the workers. Now it can be used on the employer's staging date, the date a worker becomes an eligible job holder, and the first date of employment of a new worker. An example would be a firm that has quite a large number of seasonal workers, so someone involved with the agricultural industry where they employ seasonal workers. By using the 3-month, for example, 3-month postponement period, they could actually avoid bringing in employees into the automatic enrolment, because at the next pay reference period their earnings will have dropped or they've left service. Processing opt-outs and opt-ins. Eligible job holders may opt out. As we know, eligible job holders are those employees who have to be automatically enrolled into a qualifying pension scheme. But they do have the option of opting out if they wish to do so. In order to opt out, they will have to do so within the 1-month period, which is a statutory period, and they can then receive a refund of their contributions. The rules are reasonably complex because it will depend on whether the employee has actually been contractually enrolled into a pension scheme or under the statutory enrolment basis. Non-eligible job holders may also opt in. So a non-eligible job holder, as we saw again in part 1, is an employee who does not have to be automatically enrolled, but is entitled to opt in to a qualifying pension scheme, and if they do opt in, then the employer has to make a contribution for them. Job holders may opt out during a postponement period or opt in during a postponement period. For example, if an employer is using the postponement period for seasonal workers, there's a process that they have to go through with various communication exercises about the postponement period. But an eligible job holder could then say, or someone who's potentially an eligible job holder, I would actually like to opt in to the pension scheme during that postponement period. Employers must also auto-enrol opt-outs every 3 years. So once someone actually opts out, then they should be re-enrolled after the 3-year period. Now, it's not just a 3-year period from the date they opted out, it's actually 3 years from an employer's staging date. And it doesn't apply if the individual opted out in the previous 12 months. So in theory, you could have an employee opt out and then re-enrolled just after 12 months from previously opting out into the pension scheme, and then they have the option of opting out again. The other thing which employers need to be careful of are those employees who will generally be senior employees of the company who have made pension enhancement and fixed protection elections previously, as the process of automatic enrolment could lead to a loss of their protection and substantial tax charges. So certainly anybody in the HR team in a company should be aware of that and should be aware that some of their senior employees may be caught by it and probably should flag that up. But at the same time, be careful not to be seen to inducing employees or workers to opt out. A little bit more about actual processing opt-outs and opt-ins. Employers must not encourage or induce workers to opt out, and there are substantial fines if they do so. For example, the opting out notice shouldn't really be issued by the employer. It needs to come from a third party, such as the pension provider. Employers need to keep records and track opt-outs and opt-ins, and those records need to be kept for a certain length of period, which we'll explain a bit later on in the webinar. So employers must also not encourage new joiners or potential new joiners to opt out during the recruitment process. So an employer can't say at an interview to somebody, we have a pension scheme, but you'll get the job if you decide not to join it. Record keeping. Employers will have to keep extensive records in order to prove that they are complying with their duties under the regulations. So employers need to keep accurate records. They need to ensure that they carry out their statutory duties. For example, track workers' earnings, dates of birth, because these are needed for the assessment process, employees moving between different categories of worker, job holder, earnings during each pay reference period, because they could fluctuate. Certainly if an employer has employees with fluctuating earnings, which some employees might peak at certain pay reference periods and then have lower earnings the rest of the year. So all this has to be tracked and records have to be maintained. Employers also need to be able to have the records to hand to prove to the regulator that they are complying in case they need to make regulatory returns. Now, most records need to be kept for 6 years, but opt-out notices need to be kept for 4 years. One of the ways that employers can ease the pain of having to keep all the records and to make sure that they are in fact keeping accurate records and they're complying with the regulations is to use suitable software systems which are commonly known as middleware, because they sit between the payroll and the pension provider and the other parties that may be involved in it. So they can manage assessments, the documentation and the data. Failure to comply, as we saw in part 1, this is not like stakeholder. There are serious penalties for non-compliance with the automatic enrolment legislation. The pensions regulator will encourage and facilitate compliance with the legislation. So they will help and give guidance to employers, and they produce a reasonable amount of documentation to that effect. But they can issue compliance notices, third-party compliance notices, and unpaid contribution notices. They can issue fixed penalties or escalating penalties, and the maximum penalty for a large company is £10,000 per day, and as part of the legislation is written under criminal law, up to 2 years in prison for willful non-compliance with the regulations. So how can Griffins Financial Solutions help employers? We can guide employers through the process, help them set up suitable implementation and project teams to include the most appropriate people within their business, assess and review existing schemes, advise on suitable arrangements and sectionalisation within existing schemes, advise on salary sacrifice and exchange options, communicate the pensions changes and value to the employees, because it's important that an employer gains some value from the pension scheme if they're providing a pension arrangement for their staff through things such as total reward statements. Establish cost-effective online software systems to ensure the initial and ongoing compliance with the regulations. And we can help review insurances that are linked to pension scheme membership. Quite often, certainly in the past with the larger pension schemes, historically the group life insurance, for example, or group income protection could have been linked to pension scheme membership. So people who are eligible for those group risk insurances will be those people who join the pension scheme. Now, with automatic enrolment, with larger numbers of people going into the pension scheme, that's going to mean larger numbers of people qualifying to join those group risk insurances. So they may need to be reviewed, and there may also need to be things discussing about the level of benefits and any underwriting needs that may be required. As with part one, we've also had a number of questions from employers which will help people understand some of the issues that employers are currently going through and some of the other questions that are being raised at the moment. The first question: is it possible for us as an employer to pay more into the pension scheme and the employee to pay less? The answer is yes, as long as the total contributions to the scheme are at least the statutory minimum. For example, from the 1st of October 2018, an employer for a pension scheme should have at least an 8% contribution going into it. In that case, the employer could pay the full 8% into the pension scheme and the employee not make a contribution, which would then make it a non-contributory arrangement. I'm employed by two non-related companies. Which company will have to auto-enrol me into a pension scheme? Well, the question is a little bit more complex, but it will depend on the individual's qualifying earnings and if they are above the trigger threshold for automatic enrolment. And again, we talked about the trigger threshold in part one, in that particular pay reference period. If both employments are viewed in isolation, which they have to be, and if the individual's income for each is over the threshold, both employers will have to automatically enrol the individual into a qualifying pension scheme. When you talk about postponement, is this the same as a waiting period before joining the scheme? Yes, it basically is. I mean, currently pension arrangements have often had a waiting period of 3 months. Historically, sometimes it's been longer than that, but with changes in legislation, 3 months has tended to become down to as the norm, or no waiting period at all, usually to coincide with a probationary period on joining employment. It's important that the company communicates the postponement to their workers, and under the regulations they are required to issue the workers with a postponement notice which has to contain specific information. This is a question: I'm not sure what the difference is between a qualifying pension scheme and an auto-enrolment scheme. Well, there's two ways of looking at a scheme. A qualifying scheme is one that has contribution basis, or a contribution basis, which meets or exceeds the statutory minimum. For a qualifying scheme to be also an automatic enrolment scheme, it has to meet all the administrative requirements and have a default investment fund. Can we give salary increases to those employees who decide to opt out of the pension scheme? This is quite a difficult question because a lot of the opt-out regulations and using inducements will probably be tested in the courts at some stage. But under the legislation, employers are not allowed to induce or encourage workers to opt out. They could possibly provide salary increases, but if they provide salary increases to those employees who only opt out, it could be seen to inducing those employees to leave the pension scheme. It's actually quite a difficult question to answer, and maybe some legal advice would have to be taken on that issue. That concludes the second part of our webinar on automatic enrolment. Thank you very much for attending, and if you have any questions, please contact us by email on financialsolutions@griffins.co.uk or telephone us on 01 635 551 333. Thank you.
Griffins Financial Solutions, achieving your goals together.